Welcome back to the channel. My name is Brad, and we're going to go over what my 500K covered call portfolio paid me in the month of July. If that is what you're looking for, stick around. So my name is Brad, and I've been retired now for over a year, and we're going to go into my covered call portfolio, but I'm also going to give you what changed in my portfolio, and we're also going to look at what I added and took away. And I actually added to my covered call, so it's no longer 500,000. Going into August, it's closer to 600,000, and we'll get into that. But remember what Yoda said: fear is the path to dark side. Fear leads to anger. Anger leads to hate. Hate leads to suffering. So hedge that fear. Well, he didn't say hedge that fear, but hey, I'm going to go with it because I say hedge the fear. And I think you can hedge the fear if that's what you're so afraid of. But let's not be afraid of anything because the market is going up and to the right for now. Can that change? Will it change? Maybe. Who knows? No crystal ball here. But anyway, let's go ahead and get into what is in my current portfolio and what's changed. Well, I'll throw up my business development companies. Nothing changed. I did add a little bit to the singles, and that is just what I added. My preferred stocks, exactly the same, no change. My alternatives, I added a little bit of biddy over the time period. I got rid of a couple of the master limited partnerships, and I got it down to AMLP. Now, I also went with KGLD. So I hold the gold fund from Neos, and I hold the gold fund from Curve. I hold both of them. Just go ahead and throw that out for conversations. One uses monthly calls and rolls. One uses weekly calls and expires. And I heard this analogy, or actually I read this analogy. You live in Hawaii. You're out there getting a nice suntan. You eat fish every night. Do you put one rod in, or do you use two rods? Do you use three rods? Do you use four rods and use different bait on one? Do you put a crab trap in there? Because if you only have one rod in, you might go hungry at night. Ouch. Brad wants to catch multiple fish, and he's not going to choose which fish is going to bite which bait or if I catch a crab. So hey, at the end of the day, I am going to go with multiple funds on the same asset using slightly different actual cover calls or however they generate that income, because I just don't want to get trapped with one and then be stuck with it. I'm going to use multiple. That way I can achieve my goal of a nice, smooth retirement. Now, my CLOs, well, I got rid of a bunch of them. I got rid of EIC, JBBB is gone, and JAAA is gone. Oh my, Brad, oh my. I kept FSCO, and I kept clause. I got rid of everything else. And I moved a lot of that into STRC. Probably one of my better picks that I went ahead and did, because if you don't know, the secure overnight funds rate will go down when the Fed lowers interest rates. So why am I not going to go with a 9%er compared to a 6 and a 7%er? And EIC just wasn't performing. I actually had a short conversation on some post with Steven from the Income Factory, and he's just like, well, you know, closed-end funds will always go down and to the right. Yes, you have to look at total returns on NAV, not total returns on price. And I'm like, yeah, let's just go ahead and say not for Brad. If you're going to have to do total returns on NAV and not total returns on price, because closed-end funds can trade at a premium, and he's stating that, hey, this fund is going up by X percentage on NAV. Well, you're not paying NAV, you're paying price. And that is where Brad goes, yeah, I'm going to go with a different strategy. I'm going to go with something that's going to pay me off of NAV. And I'll be able to track it off of NAV and not have a difference between my NAV and the price. At least it's going to be fairly close. So that is why I got rid of EIC and I get ahead and put it into STRC with a price of 92.13, trading up in the 97s right now, headed towards that 100. I actually did a video about that, telling you, hey, this is where I was going to hold a bunch of cash, and that's exactly what I did. I put it in there. It's going to pay me 9%, thereabouts. And remember, I got it for 92, and it's going to pay me 9% on 100, just to throw it out for where I put my cash. That's not why you're here. You're here to look at my cover calls because that is what you came along for. So my cover calls, here is my cost basis. You can also see that I added KQQQ. But you'll also notice, if you've been tracking this, my IWMI shares went down. And that's actually kind of funny. So my IWMI actually got back above my cost basis on price in my Roth IRA. I said, you know what? I always wanted to trim that position down a little bit. It's a great time to trim it. And I bought KQQQ. And if you haven't been tracking KQQQ, which you probably should, it's beating QQQI in total returns. How about that? That's 1 year's total returns. It's beating it. And it's very close to QDevo. That's another conversation for another day and maybe a different video. I'll do one on that. Everything else stayed the same, but you can see Brad's, what I'm going to call AI, went really from $95,000 up to $146,000. Didn't get any distributions on that, or very little distributions on that, and I got paid on the 95, and that's what I'm going to report to you. That's what I got paid on the 95,000 position, but now it's 146. This actually totals almost to $600,000 now. It totals $596,000. So I want to start calling this my $600,000 portfolio going forward. But we'll get into what I'm doing and how much did it pay when it was closer to the $500,000. Where did all this money come from? Well, I ended up buying a whole lot more of NVII, and I really have a good feeling about NVIDIA, and it's doing me very well. Total returns on this side is 3.3, and this is only for about a month. Now, you'll notice down in the right hand corner where it says 4,669. That's my projected distributions for the month of August, just off of this $150,000 thereabouts portfolio. If you did quick math, just to get you up to speed, if I were to put my whole $500,000 into this portfolio, that's $15,000 a month in distributions. Just to let you know exactly how much this would have paid if I just said, hey, I'm going to roll the dice and go all in on a bunch of single stocks, and I was going to be a little more risky. This is $15,000 if you go ahead and put $500,000 into it. That's not what I did. I still have my SPY-I, my QQQI, and all the rest of it, but I'm looking at this. Now, going forward, I'm buying a whole lot more of IAUI and KGLD. I want that to be a larger percentage of my portfolio because it's actually negatively correlated to SPY and the total stock market. So I want that negative correlation instead of a positive correlation. That is where I'm at. Month of July paid me $8,280. I used $4,135 to live on, and I reinvested $4,145 thereabouts. Now, going forward, that August number is going to be well into the $9,000 range just because my individual stocks has greatly increased. That's where it's at. I will still build out a little more QDevo as I go, but I really want to get more of the gold fund and maybe a little more biddy here and there. Hopefully you found this entertaining and educational, that hey, you can do a little bit of concentration and get a lot more bang for the buck, but it comes with a little more risk. I'm older, I'm in retirement. My needs might be different than your needs, but clearly $150,000 is going to pay 4,000 some odd dollars per month. Not a bad risk to reward scenario. But remember, hedge the fear. And I am looking at hedging. Not right now, because I don't see us hedging as the market's going up. But I have a close eye on a personal indicator that might tell me when to buy maybe dips or YQQQ. Until next time, God bless.